want to start actually with the issue of inflation. We've been talking about it every morning. Becky very smartly has been pointing out the price of corn, of oil, of just, everything. We can obviously talk about Bitcoin and NFTs. If this isn't inflation, what is?
Well, we obviously have a booming demand, particularly as people are going back to work. And we have supply side crimpages. We're going to see price pressures. It's across the spectrum. The real issue for the Fed, for the central bank, is whether or not this is going to be a transitory thing or becomes embedded and repetitive. We've also heard, Andrew, from various corporations. 3M just came out again with their CFO talking about the price pressures they're under, Coca-Cola, et cetera, et cetera. So these commodity prices, but also the supply side crimpages are being passed through the system. They're creating inflationary pressures. The 10-year break even is now back up a little bit, 240. So it's not clear yet how dramatic will be, A, and B, whether or not it will be, quote, transitory or not. And we'll just have to wait and see. And that's what the Fed is going to have to watch very, very carefully. The trouble,
what camp are you in, Richard?
Well, I'm a little concerned because it's a reaction function the Fed has outlined. They won't move until they're clearly understanding that inflation is going to be less than transitory, above 2%. And the problem is when the Fed acts, there's a lag between the time they act and it acts on the real economy. So we'll have to see. They're going to have to anticipate somewhat more than they're articulating, not just wait, because if they wait, and then it proves to be non-transitory, they get worried, they tighten, that could create a little bit excess of tightening or let inflation run a little bit longer than they'd like at a higher level. So again, this is a judgment call. It's going to be tough on them.
Are you surprised where rates are right now? Steve's been looking at the 10-year. Joe's been having these conversations with David Tepper, who seemingly so far has called this right.
Yeah, I mean, we had the 10-year end March above 170. It settled back down to the 150-plus level. Now it's back up again. We'll just have to see. So far, you have to remember the Fed owns 40% of Treasuries 10 years and longer, and yet rates have still risen. They're still buying a great deal. Question, will the market determine that rate or will the Fed determine that rate? Do they have yield curve control or not? I think the market's more powerful than the Fed here. We'll just have to see how it evaluates the prospects for further inflation as they drive to achieve greater levels of employment. Unemployment's at 6%, so they're not satisfied.
Shepard Smith here. Thanks for watching CNBC on YouTube.